In this video, I want to share with you a couple who wants to take $75,000 as income in retirement. And we're going to show you how they're going to pay zero in federal taxes. If we haven't met yet, my name is Tony Hansman. I'm an independent financial advisor. I help families who are in or those who are nearing retirement. And today I have a case study for you. I have Jim and Cynthia Sample. They have a net worth, liquid net worth, of about $2 million. $1.4 million in an IRA, $100,000 in a Roth, and about $500,000 in non-qualified or a dividend-paying portfolio after taxes in their brokerage account. And I'd like to jump right into our tax software. And please remember, I'm an independent financial advisor with fiduciary responsibility. However, I am not tax licensed. It's very important that you always get professional opinion and this signed off by a professional who is licensed CPA, accountant, EA of the nature. So we're going to jump right into our software and take a look at where the year 2024. And we're going to plug in here as if we've got these couple earning about $75,000 in income in W-2 wages. So if I scroll down, we're going to keep it very simple for today. We're not going to include any sort of tax-exempt interest, taxable interest, qualified dividends, no IRA distributions, Roth conversions. We're going to keep it very simple. So if I scroll down, you can see that because they are married and over the age of 65, that they have a standard deduction of $32,300 with an adjusted gross income of $75,000. So in this particular case, while they're still working, they have a taxable income of $42,700 or about a $4,660 federal tax obligation. Now, I'm not going to go into the weeds on FICA cost or individual state taxes. Everybody knows their own state and what those will possibly be, but for this sake, we're keeping it very, very simple. Now let's say that they're ready to retire. So we're going to go back up to the top, and remember they had about $4,600 in federal taxes. We're going to come back up here and we're going to eliminate that income. And you can see that goes away. And I'm going to scroll down, and the first amount of money that we're going to put in for them is that Jim and Cindy have about $58,000 in income from their Social Security. And you can see the provisional calculation is this time is zero. So if I scroll back down, we can see that they've got total income is zero, and they still have their standard deduction. That's not going to change in 2024. They get $32,300 as a standard deduction because they're both over the age of 65. It'd be a little bit less if one of them was less than 65. And so you can see their taxable income is zero and their total tax obligation is zero. So not too shabby, almost $60,000, and they have no taxable income. Now remember, they want to try to get to $75,000 and make that federal income tax as low as they possibly can. So if I scroll back up, the second strategy that we're going to use is and we're not going to do any sort of Roth conversions. I know it's pretty popular, but for this case, we're actually going to dive into their qualified money, the money that's their brokerage account. And so I can come right here and put in that they're going to take, with about $500,000 in that plan, let's just say a 3.5% dividend is $17,500. They've held that long enough to make it all eligible to be classified as long-term capital gains and qualified dividends. $17,500 is that 3.5% dividend. But you can see right here in the provisional income, now we have a taxable Social Security amount. So you'll see if I scroll down, they're going to classify the $17,500. They're going to add $8,125 for a total income of $25,800 or $625. But they still are below their standard deduction of $32,300, and you can see that they still have no taxable income. So pretty neat. So they're earning $75,500 and paying zero taxes. I mean, how amazing is that? I wish that we could do this for every single person, but I've been preaching this for a number of years, that we want to have a better balance between our IRA money, our after-tax dollars, and our tax-free dollars. So if we can do that earlier in life, then you're going to be able to have more opportunities and take strategies like this going into retirement. Now, if I come back up to the top, even though we've met their obligation or what they were hoping for with $75,000, this gives them $75,500. Let's go ahead and just bump them up to $90,000. And so what I'm going to do is I'm going to reach out over to their IRA. And I'm going to take out $14,500. And you see, if we add up these three numbers, 17.5, 14.5, plus the $58,000 is a total of $90,000 of income. Now, look at this very closely as our provisional income calculation has gone up on the Social Security again. But with $90,000 of income coming in, again, $58,000 from Social Security, $17,500 from a qualified dividend paying portfolio, and $14,500 from the IRA distribution that has $1.4 million sitting in that account. And we're assuming this is the age of 65. If I scroll back down, you can see here's our total adjusted gross income of $52,450. Now we're over our standard deduction now of $32,300. And we have a taxable income of $20,150. But remember, $17,500 of this number right here is not taxable. In 2024, we can earn a little bit more than $94,000 in long-term capital gains and pay zero tax on it. So we only have about $2,650 that is taxable, or 10% of $265. So less than $300 to receive a $90,000 income. So I love this strategy. It's a great play. You can't go too many places and get a $90,000 income in retirement and only pay $300. So this is fantastic. Now, if I wanted to, I could take them up to $100,000 if there were some high capital gains or cost basis, in that non-qualified money. We could dip into that a little bit and pay little to no taxes. So getting them $100,000 wouldn't be that difficult either. And I said at the very beginning of this had nothing to do with Roth conversions. And this looks really good in this particular calendar year. But let's be honest, there's a pink elephant in the room. And the problem is this $1.4 million, there's going to come a time when we get into our 70s where we have to pay the piper, right? They're going to come calling, they're going to come knocking at your door, and those are called required minimum distributions. You're going to be forced to take money out of those accounts, and that's going to hit our tax returns. And as that account gets bigger, you're going to have to pay quite a bit of money there. So I think the next conversation I would suggest is having a Roth conversion conversation to see what possibilities, because we want to take a look at not just in this calendar year of how much money we can save and lower our tax obligation, but how can we lower our taxes over our lifetime? And so maybe some Roth conversions is a conversation. When we get into our 70s, we could take a look at some qualified charitable donations. Or 3, QCDs, or 3, maybe some DAF, some donor advised funds. So multiple different tax strategies that we could start implementing in retirement to help lower our overall cost of taxes. Hope you enjoyed this video. Please like and subscribe if you found this very helpful. And always remember to consult a licensed professional who understands your specific goals and dreams.